Hi, I'm Ross Mayfield, investment strategist at Baird, and we're back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by managing director and technical strategist Todd Sohn. Todd, how are you doing today?
Hey Ross, I'm great. Happy February. Happy almost Valentine's Day.
Yeah, same to you. And speaking of February, I actually want to start with something that you all have written about a little bit here to start the new month, which is how January impacts the rest of the year. You've done some work on what a strong January, which we had, despite some of the volatility, means for the rest of the year. Could you break that down for us a little bit?
Yeah, the historic saying is as January goes, so goes the market. And we can boil this down to a baseball reference, right? There's 9 innings in a baseball game, on a typical game at least. And the team that gets up early, more often than not, has a higher probability of winning, right? So you think about it, if the market is up 2.5 to 3% in the first month of the year, you're already at an advantage for the remaining 11 months of the year. Of course, that's not going to rule out any sort of volatility perhaps at some point, but getting a leg up early is historically a good indication that the market is on decent footing for the rest of the year. Of course, there are going to be outlier years where things get a little bit more volatile and challenging, but it does not hurt to score points on the board this early in the year. It's a very helpful start, I think, for the overall market.
Yeah. Just looking at the evidence of history, it would say, like you said, it's not a perfect indicator, but more often than not, it's something that portends good forward returns. I want to spend the rest of the conversation talking about a couple sectors. I think we need to start with kind of technology and then, slash the Magnificent Seven, which are all tech adjacent. There's been some volatility in those names, some weakness in that area, and it's a big part of the overall market. What are you seeing from the tech sector, and how does it impact how you feel about the broad stock market going forward?
Yeah, we don't view this as the same tech sector as earlier in the cycle when it was all gears working, software, semiconductors, all different parts of that sector were outperforming. It's much more split today. There's only 60% or so of stocks in an uptrend within that sector. Semiconductors have struggled in most cases, whereas software is taking the leadership mantle within technology. I think from my point of view, in terms of the ETF world, I think it's interesting that you're still seeing persistent inflows to tech sector ETFs, so that kind of buy the dip mentality still exists. I would much rather see tech sector flows start to cool so you can get a proper washout. So for now, for the overall market, it's going to be helpful to see the other corners, the bench, really participate. And so far, so good. The equal weight S&Ps still in an uptrend. You have areas like financials, industrials, and healthcare working. And so when you have tech at 30% of the benchmark, a split scenario, not great. But overall, I actually think it's helpful for other corners to step up and start to outperform. There's a little bit more opportunity, a larger opportunity set for folks to take a look outside of just technology stocks.
Well, let's end on that and switch from tech, which is maybe the most beloved sector out there, to from my perspective, maybe one of the least loved, which is healthcare. But you all have noted kind of a nascent turn in healthcare, and it really is probably underowned, underloved. There's always the political risk storyline that circles, particularly around elections. But you've noted some life there. Can you talk a little bit about that sector?
Yeah, we really like healthcare here. We think it's very much a contrarian play. Healthcare sector ETFs have seen the largest amount of outflows over the trailing year or since the election. Pick any sort of time frame, and there's been massive outflows from healthcare. Healthcare's relative performance is in the bottom decile over the last 50 years of data. So you're looking at a sector that's really just been deserted in terms of flows, and so performance so bad it actually might be good here. Is not perfect, right? Pharma is still a little bit under fire, but if you look at stuff in equipment and you look at the providers and services names, we think that's where the emerging leadership is, especially from the equipment space, which has really been in a bear market for some time, kind of as a result of the GLP-1 movement. So we really like the healthcare equipment space. We think it's timely, and we think healthcare, being that it's the second or third largest weight within the S&P 500, is a good substitute to allocate away from tech. It has growth, it has value characteristics. And so if you're looking for something to replace some of your tech exposure, healthcare makes a lot of sense to us. And I would just say, yes, there is geopolitical, there's political risk, right? We have hearings today for RFK Jr. He's been a bit of a lightning rod. I wonder if his hearing and confirmation helps almost put a bottom in this sector, right? In terms of how negative folks have been on this space. That's not data driven, more anecdotal driven, but I just think another interesting breadcrumb out there to help support the healthcare case going forward.
Yeah, very interesting. It's a very diverse sector, but always on the hunt for a turn, particularly when the same kind of stocks have been working for so long. You're always looking for those other opportunities. So, Todd, thank you so much for the time. As always, we'll look forward to doing it again soon, and have a great one.
You too, Ross. Thanks a lot.